Hello. So this is the story of my portfolio. So how can you understand the story of my portfolio without first understanding me, who's the steward of my capital? So for investors that are particularly interested into understanding what are the different positions that I have currently, I'll leave the link to two separate videos. The videos were made back in July. They are fairly updated. I haven't really added more position. I am still averaging in to some positions, but generally speaking, the percentage of how I allocate my capital is the same. So just some background context, and maybe just to share with you some childhood memories and some of the childhood stories. I would probably share three notable events that have made me realize and to also have a better or more deeper appreciation and understanding behind these three core values that I really hold true to my heart. They are mainly prudence, patience, and optimism. So of course, some naysayers will push back and say that how are you even prudent? You have 80% allocated in China or Chinese tech. I will take that question later on in this video, but let me just share a little bit. I was essentially brought up in a relatively frugal environment. So if you would want me to describe my family or my household, I'm actually a single child, and when I was brought up, I don't think we are particularly well off because I don't stay in a landed property and stuff like that. But I really didn't have to worry about my next meal. And whenever I wanted or requested for something, my parents will readily agree. And I was deeply doted on, so I'm eternally grateful for that. But that said, we don't really have great amount of disposable income at our disposal. I can't really just say that, mommy or daddy, can you just buy me a condo or buy me a landed unit, and they're able to kind of foot it off. No, I'm not in that kind of privileged position, but still very privileged. I acknowledge that fact. So back then, I think my dad was really the influential and instrumental figure in my life. He was firstly very frugal, he was very thrifty, and he really has this quote that he kind of holds dear to his heart. It's actually in Chinese. It's called 钱要花在刀口上, meaning your money has to be put to effective use. And $1 that is not effectively used is $1 wasted. So that was really his governing principle in life. In 2016, I first had my first taste of getting into the stock market was also all thanks to my dad. So my dad is an avid investor himself. He hasn't stepped out of the Singapore market. So I think even till today, most, if not all of his investment is actually in the SGX, which is the Singapore Exchange. I believe that he did pretty well, not astronomically well to be the Buffett of Singapore, but he did passable. I think on the aggregate, he did share before that he's positive. Unlike many others, many people that are early investors in the Singapore market and has lost a great deal amount of money. But that's besides the point. I think the focus here is really his engagement and really his initiative to try to bring me into the investment world as early as possible. So for those of you who don't really know, I think in Singapore, or at least in the Chinese culture, the young ones tend to get a lot of pocket money through the festive seasons, particularly so Chinese New Year's. So during the Chinese New Year or Lunar New Year event, you'll get red packets and your relatives will give you a small token sum. And then through the years, you basically save them in your savings account or in your piggy bank. And back then in 2016, I believe I was probably secondary 4 or in JC1. And I've already accumulated a good sum of money in my piggy bank. And my dad was basically just trying to convince me that to dip my toes into the investment market. So one fine day, he basically came to me and pitched to me a deal. I believe the first stock that I ever owned in inverted commas, through my dad, was this company called Keppel Corporation. Back then, I didn't really know what Keppel Corp do, but I know it was a large cap. It was essentially a blue chip. It was in the oil and gas industry. And they were paying healthy dividends. I think it was around 4-5%. And back then I had around $4,000 to $5,000 that was saved up. For SGX companies, they were in the lot sizes of 1,000. So if you just wanted to buy one stock, you have to buy 1,000 shares of it. And Keppel back then was trading at around $5 per share. So 5 times 1,000 is $5,000. And my dad was saying that. I believe he was saying that he's going to buy like 10 lots or 20 lots of that share. And he told me, hey, I can broker you a deal. I can give you, you can buy one lot from me, and then for the rest of it, I'll just buy it for myself. And back then, of course, I'm under 18, so I didn't have the ability to open a brokerage account. So silly me, I was just thinking that, oh, my dad have probably done his due diligence, so I'll just buy alongside him, and I just handed over the $5,000 I had in my savings account. And from there on, that was really my first taste into investing in a stock. And also from there on, I kind of understood and have a better appreciation of what are companies, why they need to issue stock, and I also had the first taste of my dividend. So back then, I believe Keppel was giving out like $100-$200 of dividends per year because it's a 5% on my 5% of my $5,000 investment. And hey, it was good money, right? I didn't have to do anything. I was basically laying flat at home, and I get $200 per year on a $5,000 capital. And I believe actually Keppel went up by quite a bit, not like 1x or 2x, but at least I think 10-20%. So on top of dividends, I actually get capital gains. So it was a win-win. And I think my second stock from there on, when I was in army, was actually DBS Bank. And the rest was history. I basically started in the Singapore market. Then after the COVID crash, I pivoted to the US market. And last but not least, currently, I have an overemphasis and a focus in the Hong Kong market. A lot of you probably know that I'm heavyweight into many of these Chinese tech and Chinese businesses. So that's basically the story of how it started me going into the investment world. So back to the 3 core values, let me share 3 notable events and experiences that have essentially shaped how I looked at investing and life in general. So the first core value about prudence. I think throughout my life, my dad has been sharing many stories because the easiest way for you to learn is from other people's experiences. And one of the most convenient way for today is, of course, through books. That's why people have been recommending, even Buffett is saying that, hey, you should go and read through other people's lenses and other people's experiences. But for me, thankfully, I was in a privileged position. My dad shared with me a lot of his own experiences and what I should avoid, which allowed me to have a shortcut into not making many of these very dumb, very stupid mistakes that most early investors did. So on the first part of prudence, he essentially sat through the entire 98 financial crisis. And for those of you who don't know, I think even the 2008 great financial crisis didn't really affect Singapore much compared to the Asian financial crisis. 98 was really the one that basically took the entire Southeast Asia down into a hellhole. Malaysia, Thailand, Singapore, all of us were basically gone for. So from his own experience, he too was young. So back then in 1998, he was also in the business of flipping properties. And back then, the Singapore property market wasn't so restrictive, and you can probably own multiple properties, and they don't really do a very stringent check, credit check at least, in terms of your salary and your ability to repay your mortgages. And I think at one point in time, at the peak, he was holding on to multiple properties and he was leveraged to the T. Thankfully, of course, he was liquidated, he was burnt, but he's still with us today. But a lot of his friends, when he was sharing many of these heart-wrenching stories, his friends, his acquaintances, some of them had to take their lives. They were basically jumping off the building because they couldn't meet their debt obligations. And this was the first lesson and first idea that was hammered into my head. Always focus on the downside. Leverage is like fire. When done well, it will amplify your returns. When done badly, it will literally end your life. So that was really my first experience into understanding the idea behind prudence, and always trying to manage your downside and let the upside take care of itself. So that was my first perspective on prudence, the idea of prudence. Secondly, it's really the value of being patient. So I'm just going to share with you a very interesting story that I had. So right now I'm using an iPhone 12. If you guys don't know, I hope you guys can see. I'm not a beauty influencer, but yes, I'm using an iPhone 12. And I went to dig up how much I spent on this iPhone 12. So the iPhone 12 was actually released in October of 2020. And the retail price back then was around $1,400 Singapore dollars. And right now, even on Apple's website in 2023, which is give or take 3 years later, they've reduced the price by around $400, which is 1,000 Singapore dollars. And I've actually bought this iPhone 12 back in 2022, early 2022 in fact. And it cost me around $800. So some might be thinking, hey, 800 and 1,004, that's a big delta difference, right? It's because this particular iPhone 12 is actually second-hand. So back then in 2022, when I was on the lookout to buy a new iPhone, the latest model was actually iPhone 13. But I sat down and I looked at the specs and I thought to myself, actually I don't need to buy the latest and greatest. One generation behind probably checks the same boxes. I'm not doing something extraordinary, so I didn't need those capabilities. And also, it's of course definitely gonna be cheaper if you buy one generation behind. So that's the first point. And the second point really is the idea of you not being desperate for it. So before this changed to an iPhone 12, I was using an iPhone SE. My iPhone SE was actually doing fine, but my only grunt was that the battery life was pretty short. That's why I wanted to upgrade to a more later iPhone. So back then, I was basically scrolling through Carousel and I was looking for a good deal. iPhone 12, I'm looking at the battery condition, looking at the scarves and whatnot. And that is why I have this experience where if you want expediency, you will have to pay for it. If you're urgent, you are no longer in the position of strength to negotiate. This is applicable throughout life and even in investing. When you're urgent, when you're always on the lookout, when you're desperate, you're always negotiating from a position of weakness. So particularly so in investing, where people are touting, people are banging on the table saying that, oh, this investment is an opportunity of your lifetime. Don't forget. And once you miss this opportunity out, you're going to miss out on generational wealth. And that is when a lot of my red flags and my siren goes off ringing and say that, oh, this guy is probably going to smoke me. Because I think for those of you who have been following on many of these generational companies, whether it's Tesla, Nvidia, Apple, many of them have also been traded down by quite a large extent before. The issue really is your ability or inability to look into the future. Anything that you do when you're desperate is going to cause more harm than good. So the third value is optimism. So similarly, I'm going to draw from an experience that my dad shared with me. This was back in 1997, where Hong Kong was slated to be returned to China by their ex-colonial masters, which is the British. Back then, I think months leading to that return, there was a huge immigration out of Hong Kong. People were basically seeking refuge in Singapore, in Malaysia, in the US, in British, because they are probably more familiar with their culture. And a lot of people were saying that, China back then was a lot more less developed. They didn't have the capability to govern Hong Kong effectively. And it was really a very bleak outlook then. But I think over the last 20 years or so, post 1997, you can tell that Hong Kong was part of the Four Asian Tigers. They have experienced great amount of prosperity and development. And people will again argue that over the last 5 years, it has been bad for Hong Kong. But we cannot deny the fact that back in 1997, when there was an handover back to China, a lot of people was looking down at Hong Kong and they've proven their worth. Markets and economies move in cycles. And linking it back to the first and second point, if you're not leveraged and if you're not desperate, you can always negotiate life from a position of strength. So that's just my own perspective. And of course, for you to hold on to optimism, you have to ground it in a certain level of pragmatism and reality. So a lot of people like to argue that, hey, you look at the Singapore Straits Time Index and you look at the Hang Seng Index and you look at the CSI 300 or even the Nikkei Index. Many of them have not recovered to their all-time highs and they've essentially experienced a lost decade or are experiencing a lost decade. The funny thing is, that is because you have compared it to its peak periods where you are talking about peak valuations, and some of these numbers just didn't make sense back then. But if you really started to bargain hunt and start to buy them on the lows, I think many investors actually experience a healthy level of gains. And this is just to each its own. That is also why I can't really control how the market is going to move. The only thing I can control is two things: what I buy and when I buy it, which is aka the valuations. And from the perspective where I own a lot of the companies or a lot of the indexes at relatively low valuations, really allow me to take care of the downside and let the upside take care of itself. And it's really during times of adversity and pessimism, you're able to hook yourself up with many of these great deals. Some of them really look extremely dirt cheap. For people that have the courage, please feel free to carry on. For those of you who don't, then continue buying things that just constantly goes up in a straight line and think that everything is well. But not everything is fine and dandy, and don't forget that things always move in a cycle. So that's that. And last but not least, I just want to kind of address this seemingly contradictory statement where I say that I value prudence, yet at the same time I stock pick. I am extremely concentrated in a few positions, and worse still, I'm invested heavily in Chinese equities and Chinese stocks. So first things first, I think my idea of prudence is really on a very broad macro level, which is don't take on leverage, don't play with money that you don't have. So that's the first layer. I'm currently not leveraged, so I hope I square that away. On the second point about risk taking, why am I picking stocks versus not putting into index funds? I probably have two reasons. Number one, I do have index funds, it's just that they are not a majority of my portfolio. Number two, indexing particularly probably wouldn't achieve my objective that I want to achieve in life. So all of us have our own financial planning and stuff. So just doing into index investing doesn't really achieve my objective on two folds. Number one, at least on the return perspective, and number two, on the learning perspective. Meaning I don't want to put my money into a black box and not know what I invest in and have zero learnings coming from it. So when the index drops like 20, 30, 50%, I don't even know what I'm holding on to. I just hold on to it's basically just a blind faith and blind optimism telling myself that, oh, it will definitely recover. So that's my two differing objectives from just indexing. And of course, with this saying that I want to know how I die. So when I allocate my capital and I still lose money, there are many beneficial experiences that I can gain throughout the process itself. So that's that on index investing versus individual stock. And on the third level, where you talk about individual companies in a geographic region like China, Chinese equities, do you know how risky it is? So just some perspective again, background context. My position right now, it's split into 80-20. 80% is in Chinese positions, 20% is in US or Taiwan or the worldwide positions. So out of this 80%, I believe around 60% is in Chinese tech, while the rest, I do hold some sort of Chinese discretionaries. I hold Chinese banks in the financial sector and stuff like that. So that's that. So that's the breakdown. So I'm not technically really all in into Chinese tech, but yes, it makes up a majority of my portfolio, around 50 to 60%. Why are you taking up so much risk and whatnot? So my answer to that is on two folds. Number one, of course, I view the risk differently from many people when investing in many of these Chinese stocks. Maybe if you want to put it on a relative scale, many US investors or international investors would put investing in China with 100% risk level. But to me, just solely talking about this geographical risk, it's a lot lower, maybe on a 25-30% level. If I'm going to lose money on many of these Chinese investments, it's really on my inaccurate analysis and my inability to forecast the future of many of these Chinese stocks. And not so much because it's Chinese equities, because for every one company that they can tell me that Chinese equities are fraud or Chinese companies that didn't benefit shareholders, on the other side, can also list out Chinese companies that benefited shareholders greatly over the last 10-20 years. So that's really a moot argument in my perspective. So on that front, geographical risks, I'm not too concerned. The second part really is to kind of dispel this idea. Overall, if you want to count the entire basket of Chinese equities, of course I'm still deep in the red because of my Alibaba position. It's extremely huge. And I bought in a little bit too early. But on the aggregate, if you look at it and compare it across all the different positions that I have, the different Chinese positions that I have, I think I have 8 Chinese positions now, and only 2 of them are in the red, and namely it's Baba and also KWEB. So both of them is because I started the position too early on, and I averaged down too aggressively, which is why my average price is a lot higher. So I have other companies like my multiple Chinese banks, I have Haidilao, I have Tencent. Most of them are accumulated at the lows. My valuation is at rock bottom. I took care of the downside. That's why the upside will take care of himself. So that's just some perspective into saying that, oh, all Chinese equities are gonna ensure that you lose money. That's not my experience, at least. So going back to the two things that I talk about, I can only control what I buy and when I buy it. And that is my only framework as an investor, at least as a retail investor. And the third point, to kind of address this seemingly contradictory statement, I would just like to say that, at least from my own personal assessment, my current exposure in the market is not huge. It's not huge by any means in the grander scheme of things. Just some perspective, you probably want to compare your current portfolio value versus your future potential income generation ability. Of course, you tell me that if today I'm managing $1-2 million, then I'm gonna probably adopt a much more diversified approach. Let's do a hypothetical. Let's say I manage a $50,000 portfolio and my annual income is $50,000. it's 1 times of my annual income. And you tell me that, I'm going to follow the 5% diversification rule. I must have at least 20 names in my portfolio. So it means that every name, I have a $2,500 exposure. It wouldn't move the needle on my portfolio, and I honestly don't have so much time to follow every single companies, more than 20 companies in my portfolio, unless I do it full time. So those are some practical considerations, and also from a financial planning perspective, it's not really realistic in a way for me to hold 20, 30, 40 companies and to follow them every single quarter. And on an absolute dollar value, having $2,000, $3,000 exposure on one company, that's far from having skin in the game, at least for my own personalized journey. So I hope I kind of answered the question. And of course, for those of you who have been following, you will probably know that I'm capping my Chinese exposure right now, and I'm using all the new monies coming into the portfolio to build up other positions. So that's basically my own plan. So I hope you enjoyed this discussion. I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye!